Today is Monday, December 8th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, Mark Bowman, and JP Steiner, all from the ADMIS Research Team. And starting with the grains this morning, Mark Soderberg, what are your expectations for tomorrow's USDA WASDE report?
Historically, we've not seen significant changes in the USDA balance sheets in the month of December, particularly for soybeans. In fact, there's been no changes to the ending stocks in beans here now the last 4 years, and only twice in the past decade. That said, however, I do look for the USDA to raise their ending stocks tomorrow, 20 million bushels. This coming from a 40 million bushel cut in exports, partially offset by a 20 million bushel increase in crush. So I'm just a little bit above the average trade guesses, which is looking for a 10 million bushel increase. Last year in corn, we did see a huge 200 million bushel drop in stocks in the December report, by far the biggest change in the past decade. That as a result of higher exports. This time around, I look for a 50 million bushel cut in stocks. I'm looking for a 100 million bushel increase in exports, partially offset by a 50 million bushel cut in the feed usage category. The average estimate from Reuters is looking for about a 30 million bushel cut, so I'm looking for a little bit more of a cut than that. I see no changes in the wheat ending stocks, holding at 901. The average trade guess is looking for about a 10 million bushel drop, likely on higher exports. I just think USDA stands pat this month, as we're likely to see higher global production from Argentina, Canada, and possibly Australia. So look for stocks among global exporters to remain elevated. I also don't see any changes this month in corn or soybean production in South America, as we still relatively early for much of their crop in this current crop cycle. However, I would lean a little bit higher if we do see any changes, just due to favorable conditions to date.
And Mark, the Commitment of Treasury report shows a buildup of speculative longs in the soybean market. Is this concerning to you?
Yeah, it is. I think it has to be very concerning to market bulls when you look at that most recent CFTC data. As of late October, it showed money managers were net buyers for the week, just over 83,000 contracts. This extended their long position to 118,000. This is the most they've bought in any given week since May of 2024, when they purchased a record amount of just over 107,000 contracts. Recall, this data is back in the latter part of October, when President Trump did meet with Chinese leader Yi in South Korea, where they announced their intentions to resume purchasing of U.S. beans. The money manager long position as of October at just over 118,000 contracts. And I suspect during the month of November, data will show it eventually peaked at over 160,000. So while Chinese purchases have started to show up on the USDA sales data, and many still seem skeptical that they will purchase 12 million metric tons that the Trump administration claims they have agreed to, particularly when you look at offers coming out of South America, about 50 to 70 cents per bushel below U.S. offers in Q1 of next year. So prices have pulled back pretty significantly from that mid-November peak, while looking for higher stocks tomorrow. So there's still a gap on the charts here for the spot January contract around the 1063 to 1070 level. And I think that's an area we're going to go try to infill here as we round out 2025.
Thanks, Mark. Mark Bowman, what's ahead for the cotton market?
So Mark mentioned the WASDE report. We have that for cotton as well. The latest survey, the Bloomberg survey, has a trade expectation for production around 14.16 million bales. That's only up slightly from 14.12 million in November. Still compares to slightly higher than a year ago, 14.41 million. They're looking for a slight decline in exports to 12.09 million versus 12.2 million in November. And ending stocks would be at 4.4 million versus 4.3 million in November. So a slight loosening. The stocks to usage ratio this would be around 31.9%. versus 30.9% estimated in November, 29.4% last year, and a 5-year average of 26.4%. So this would be the highest the ratio has been since 22-23, when it reached 32.1%. And so still a loose situation. As far as World numbers as well. They're looking at world ending stocks to be around 76.14 million bales versus 75.93 million in November, with stocks usage at 64.3%, also the highest since 22-23. Other issue is ending export sales. Export sales, of course, we're catching up from all the delays from the shutdown, and we had a report this morning for the week ending November 6th, and that was really strong. It was 292,146 bales for the current marketing year, and another 96,792 for next year, for a total of almost 390,000 bales. And this is up compared to only 89,450 last week, and it was the highest since January 16th. Now, sales still way behind, 47% of the USDA forecast for the marketing year versus a 5-year average of 63% for this point in the season. So this would suggest that the USDA will continue to lower their export forecast, and thus bring up their estimate for ending stocks. And this seems to be the way that trade seems to be thinking it's going to happen. They are well behind. I mean, this is like the slowest pace in 11 years or so. But we do have to express a little caution because we're still several weeks behind, and they may be reluctant to do so until they get a more complete picture of the export sales.
We continue to watch that. Mark, natural gas. Has this market put in a top?
Well, you know, we traded on Friday. We reached its highest level since April 4th, but then closed well off the day's high, leaving kind of a spike top. The nearby contract also reached its highest level since December 22nd, also showing a spike high. We gapped lower this morning on the open, and this invited some long liquidation. But I got to think the rally was so sharp, so fast, that it was not surprising the market got ahead of itself. And so there could be room for a correction. Still, we have the cold weather in the eastern half still coming in pretty good. We got a 6 to 10 day forecast, still shows much below normal temperatures from the Great Lakes all the way over to the mid-Atlantic, and some colder than normal, really extending all the way down to the Gulf Coast from Louisiana eastward. We see a little moderation in the 8 to 14 day, less extreme cold, but still present. And so if this continues, we could start to see the picture turn to a much tighter situation and see us go to a net deficit from a year ago for the first time since April. We also got a couple of other supportive factors. One is another supportive factor is the strong LNG export pace that we have, and also longer term, higher demand as more data centers come online. So I'm not entirely ready to give up on this rally, but we could be due for at least a short-term correction.
Thanks, Mark. JP, the Fed is meeting on Wednesday. What should traders be looking for?
Well, not to beat a dead horse, but this week's Fed meeting has been eagerly awaited for several weeks, really ever since the end of the October meeting, as the government shutdown has done really nothing but amplify speculation about how the Fed will move on monetary policy with a lack of official data. With that out of the way, what is notable about this Fed meeting is that they will be updating, or the Fed will be updating its summary of economic projections, including its famous dot plot, which forecasts what policymakers' projections are for GDP growth, unemployment, inflation, and importantly, the Fed funds rate. Currently, the median values of the summary of economic projections at its last meeting showed real GDP growth at 1.6% for 2025, the unemployment rate at 4.5%, inflation at 3%, and the Fed funds rate at 3.6%. So markets will be analyzing any sort of changes to these projections as the economic landscape has sort of been frozen by a lack of data. Inflation still remains a concern for several officials, so it will be interesting to see how those expectations are reflected in the dot plot. Of course, there will also be Powell's presser following the rate decision, which always brings a strong reaction in markets. Recently, in some of the last couple of rate cuts, we have seen the Fed shifting towards a sort of a hawkish cut stance in its post-meeting commentary. So any signals that deviate far to the hawkish side or the dovish side will certainly be telling.
And lastly, JP, when it comes to 2026, what's in store for U.S. monetary policy?
It's certainly going to be an interesting year for monetary policy for several reasons. One is that as January begins, we'll start to see the resumption of timely U.S. government data. That will offer us a greater understanding of how the economy is holding up. Labor market figures obviously going to be heavily scrutinized as well. Weakness in the jobs market has been a main priority for the Fed recently, which notably has shifted a little bit to accommodate the labor market overtaming inflation. And on the inflation front, as far as we know, that has been tame in comparison to the surge that many economists thought would happen as a result of tariffs. Now, time will certainly tell when it comes to the inflation front, but that doesn't mean that inflation isn't a problem. Inflation's still resting at 3%, which is well above the Fed's target, and affordability has been a huge concern for many Americans, and rightly so. Services inflation, which also tends to be stickier, is resting at 3.6%. That's been trending down over the last couple of readings, but still a huge concern for many FOMC officials. And in an economy with labor market issues, without labor market issues, would likely require the Fed to hold on rates to tame. Also in 2026 will be the end of Fed Chair Powell's term in May. His replacement is increasingly looking like Kevin Hassett, who is currently the director of the National Economic Council for the White House. Hassett will certainly bring a dovish tilt to the Fed in a time where inflation is still not entirely controlled and resting well above the Fed's target. It looks like inflation could be here to stay elevated for 2026. So as far as for a broad outlook on monetary policy, I do respect the Fed to remain cautious until Powell's term is over in May, potentially not lowering rates at all, barring any sort of dramatic falls in the labor market. After Powell's gone, I definitely expect a dovish push on the Fed, where we could see interest rates fall by around 50 basis points by year end. There will still be several officials who will be vocal about their inflation concerns, and I expect them to potentially limit the amount of easing that Hassett would initially like to see.
Thank you all. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.